So in this lesson, we're going to be looking at market conditions. So what are the market conditions? Well, basically we have two market conditions, a trending market and a ranging market. At least that's what I look at. So a trending market is simply when we're making clear higher highs, higher lows. The market is moving upwards or moving downwards. There's no sideways movement. It's either trending up or it's trending down. So if it's trending upwards, it will be making higher highs, higher lows, higher highs, higher lows, and higher highs. If it's trending downwards, it will be making lower lows, lower highs, lower lows, lower highs, and lower lows, right? That's the trending market. That's the basis of a trending market. So one thing you need to understand is bullish and bearish. A bullish market is when it's moving up. A bearish market is when it's moving down, okay? That's the only difference. Bullish is up, bearish is down. Bulls or bears, right? Now, a ranging market is when it's moving sideways, okay? And it's not trending, it's just literally moving sideways. A ranging market typically means that there's support and there's resistance. And price action is right in between there, just trending right in between. Not trending, but ranging right in between that support and resistance. And it's very important to identify both market conditions, because when it comes to my management style, entries themselves, the strategies themselves, you can execute them whether it's a ranging market or a trending market, it does not matter, okay? But management, it becomes important, and that's why you need to understand which market you're in, whether you're in a trending market or whether you're in a ranging market, because it will matter how you manage that potential setup, that position, that trade, whether it's going to be a long-term trade or whether it's going to be short-term trade, whether you're going to be more aggressive on your management or whether you can be a little bit more loose on your management. Now, one thing with a trending market is that you got to understand is that there's runs and there's pullbacks, okay? So if you have a bullish trend, you're going to have runs and then you're going to have pullbacks within that bullish trend. And that's also important to understand, because when it comes to management, again, you can use the strategies to take a pullback play or pullback trade, or take a trade with the run, okay? And you're gonna have a better understanding when we look at the chart and as you go through this course of what I'm talking about. But again, it's important to understand whether it's a pullback or whether it's a run, whether it's a trend or whether it's a range, because again, management will differ. Entries will be the same. There's 5 strategies that I will teach you. That's the 5 strategies that I trade personally. Now, the management is going to differ, whether it's a pullback, whether it's a run, whether it's a bullish trend or bearish trend, or whether it's at the beginning of a trend or at the end of a trend also, and a ranging market is also going to make a difference in management. So with that said, this is a very important lesson, but it's a simple lesson as well. We're going to get much more deeper into analysis shortly in a lesson or two. That's when we're going to start fully focusing on price action patterns and then eventually multi-time frame analysis. But this is still the basics, but very important to understand. So with that said, guys, let's have a look at those charts. So in this lesson, we're covering trending markets and ranging markets, and what's the difference between the two, okay? So for this lesson, we're going to be looking at pound CAD, so British pound, Canadian dollar, and let's start off with what is a trending market, okay? So we can have a bullish trend or a bearish trend. A bullish trend is when price is moving up, a bearish trend is when price is moving down. Okay, simple. Bullish trend, bearish trend, right? So we're just moving downwards, moving upwards. Now, what is a trend? Okay, a trend, let me pull up a drawing tool, move this to the side. A trend will look something like this. We have a bullish run, okay? So a run, pullback, run, pullback, okay? Run, and then potentially, another pullback, okay? This might be farther, maybe it will go farther down, okay? Run, but now it's stopped. Maybe it did not continue all the way up there. it stopped there. And then it reversed. Run down, pull back. Okay, run down, pull back. And a run down to the lows. Okay, so what do we have here? We have a bullish trend with a run, okay, then a pullback, a run and a pullback and a run. Okay, so now over here at this point we were in a bullish trend, making higher high, higher low, higher high, higher low, higher high. Okay, so this is important. That's kind of how you determine whether it's trending or ranging. Do we have higher highs and higher lows in the market? Okay, so that's just the close price of the run. So we have a higher high, higher low, higher high, higher low, higher high in a bullish trend. Okay, then over here all of a sudden we did not have a higher low. Okay, we're neutral. Guess what? This is support and resistance. Right, so it's neutral. Then it went on. Did we get a higher high? No, it did not continue its bullish trend, right? It did not make a higher high, but instead it made a lower high. So now we're not in a bullish trend no more. The bullish trend is coming to an end and we're getting this lower high. Then all of a sudden we break our support, right? And make a lower low. Previous low, lower low. Now we're in a bearish trend. And then a break, retest of support, lower high, lower low, lower high, lower low. Okay, so that's the basis of a trending market. With either making higher highs, higher lows, trending upwards, or lower highs, lower lows, trending downwards. Bullish trend, bearish trend. Okay, up here what we have is price action deceleration. Okay, so we saw candlestick deceleration in the previous lesson. But there's also price action deceleration. And we're going to be digging into price action patterns soon in the coming up lesson. And you're going to understand price action deceleration a little bit more. But this is referred to a head and shoulder pattern. Left shoulder, head, neckline, right shoulder, and then a breakdown. Okay, so there's price action deceleration as well, and that is this. Okay, so now let's have a look at a proper chart. Well, what do we have here? Okay, so let's start off here. We were trending downwards, okay? So first we were making these higher highs, higher low, and all of a sudden, did we make a higher high? No, we did not. All of a sudden, we went on to, I'm just gonna delete this line. We went on to make a lower high, then we broke down, lower low, previous low, lower low, and we continued. Lower high, lower low, lower high, lower low. Okay, and this is when things change. All of a sudden from here, price action went up, higher high, higher low, higher high, higher low, higher high. Then this is more of a deeper pullback. It's called a complex pullback. And then we continued with that bullish trend. Okay, so a few things you need to be familiar with. A run and a pullback. Okay, so a run is typically when you're going with the trend. Okay, so when we're trading with the trend, let's focus on this trend right here, this bullish trend, okay? A run is when you're going with the trend. So this starts off, it potentially started off as a pullback because we were in this bearish trend, but when it broke out, it became a run. Then this was a pullback, okay? And then a run, another pullback and a run. And this is a deeper pullback and then another run. Okay, so we have a run and we have pullbacks. That's kind of all you need to be familiar with. Now over here, remember we talked about MACD divergence. Okay, so MACD divergence will happen at the end of a trend, and we have it here. Okay, so let's draw in our line. Price action from the same time period is making lower lows, right? You see that. Lower lows, lower low, lower low, lower low. While MACD started to reverse, it did not follow the trend. It was not making lower lows. It started to make a higher low and a higher low. So this is MACD divergence, okay? And then all of a sudden we broke out to the upside. And guess what we made? We made a head and shoulder pattern, an inverted head and shoulder pattern. Same thing as what we saw here, okay? This guy right there, but the opposite, an inverted head and shoulder pattern. Left shoulder, head, neckline above, right shoulder, and then the bullish trend started. Okay, so that's a trending market, and you're gonna have much more exposure with that the farther we go into the lessons. Okay, but that's the basis of the trending market. That's what you need to know, is that we are trending in cycles, then there's deceleration, typically followed by bullish MACD, and then a trend change. Okay, a trend change, you're gonna have some kind of a breakout and a new trend begins. Okay, now what is a ranging market? A ranging market is when things are moving sideways. Okay, we are not trending, but we are ranging. So you see this time period over here? It looks like consolidation, right? So consolidation on a higher time frame will be a range on a lower time frame most often. And we're going to dig into multi-time frame analysis in the coming up lessons, and I'll show you how deceleration and consolidation looks based on multi-time frame analysis, which is going to be one of the most important lessons that we're going to dig into. But before we dig into that, because that gets complex, we need to know the basis, right? So what is a range? So this on a daily chart will be a range. Okay, so let's jump back to that time. Let's go all the way to that ranging market. Make it larger. So here we are. And that looks ugly, right? It's not going anywhere. So check it out. Let's zoom out. And you can see here we were in a bearish trend, you know, overall in general. Lower low, lower high, lower low. Then we had a range, price moving sideways. Okay? Literally. Between this support and this resistance, and right there. We got a range. Price is moving sideways. It is not trending, it's moving sideways. And then again, it started trending, it started to move down, okay, overall, until this major ranging market right here. And a range typically has support and resistance on either side, at the highs and at the lows, okay? That's why it's ranging. It's because it's rejecting something, okay? That's why we have a range. Range means it doesn't just happen randomly. A range happens because there's very strong resistance, like in this case, we get the extreme highs, major resistance, right? And we got major support, extreme lows. So a ranging market typically happens between major support levels, like in this case. So you can still trade ranging markets because there's still moves that happen within a ranging market, right? Still got moves, we still got big runs and big pullbacks. However, in a ranging market, pretty much everything is a run. You know, we got a run to the upside, and we got just the random consolidation. Like a range typically has a lot of consolidation within it too. It's also got a lot of runs and such, you know. So we got a run to the top of the range, then you got a run to the bottom of the range, and a run to the top of the range, you know, and then consolidation, just random price action. So that's what you need to be familiar with, is that in a ranging markets, we typically go to the bottom and to the top. And with that said, that is kind of it, you know? So now you know two market conditions, ranging and trending. We're gonna dig much more into this when we start looking at multi-time frame analysis, but it's very important for you guys to have this basic knowledge of what is a trend, what is a range, and how I look at it, you know? So I like to trade the runs, you know, so when I'll be trading, we'll be trading the trend, okay? We'll be focusing on the trending market. That's where you can make the most money, in my opinion, at least with using my strategies, is when you're focusing on the runs of a specific trend. The pullbacks is where the short-term kind of day trades happen. The runs is where you can make the most profit, okay? Where you're trading with the trend, okay? That's something you're gonna hear me say all the time. Trading with the trend, or trading against the trend, okay? When you're trading against the trend, you're gonna have to be more aware, more cautious, because there's more risk with trading against the trend, because the trend is bullish. The overall pressure, the overall momentum of the market is bullish trend, right? So trading against that is a little bit risky, but there's still ways to do it. It's all in management, right? So that's what we're going to be focusing on. When it comes to the ranging market, We can also trade a ranging market. The management is just going to be different, and all of that is going to be explained the farther we get into this masterclass. But for now, that's all you got to know. There's going to be another lesson focusing on this, which is going to be digging farther into multi-time frame analysis. But for now, that is it. That's the basis of the trending market. To summarize, runs, higher highs, higher lows, that's a trend. Runs and pullbacks, giving you higher highs and higher lows, right? That is a bullish trend. Or lower lows, lower highs, that is a bearish trend, filled with runs and pullbacks. A ranging market is sideways price action between two major support and resistance levels. That will give you a range. Review this lesson as many times as you need to, and I'll see you guys in the next one.